I think we sort of left it at the call option stage, so we're going to look at the put option. So call option, briefly, if you recall, is the right but not the obligation to buy underlying stock at preset prices within a period, preset period after which the options expire. So if you don't do anything, they just simply expire. Put options work the other way. Put options are, so as the definition says, gives one the right but not the obligation to sell underlying shares at the strike price. So call options give the holder the right to buy shares. Now, now here's where I'm going to say something that's going to sound extremely well. Okay, let me just say it without the preamble. So you can have, I said buying call options, right? So when you buy a call option, you have somebody selling the call option. So option trades, as they are called, are a zero-sum game, which means that there's always a paired transaction. So when you buy a call option, somebody has sold that call option. Okay, so when you buy a put option, somebody has sold the put option. So there's always a seller and a buyer. Now the question is, how do I know who the other side? You don't know and you don't care. There's a mainframe computer or many computers that keep track of that for you. It's not our business as traders to know who the other party is, and it doesn't really matter who the other party is, right? So when you buy a call option, somebody has sold that call option. That gets paired on with you. So it's a paired trade. Always, again, as I said, who the other side of that paired trade is not your concern. It doesn't change anything. It doesn't even matter. But understand that there's always a paired transaction going on in option trades, which is why it's called a zero-sum game. So when you win, somebody's lost an equal sum on the other side. You lose, somebody else is gaining that. So that's why it's a zero-sum game, that these transactions net out to zero between a buyer and a seller. So when you buy a call option, somebody has sold the call option. When you buy a put option, somebody has sold the put option. And we'll talk about buying and selling and the risks involved therein. But let's look at the buy side for the moment. So this is, again, buying the put option, buying the right to sell underlying shares at the price stated before its expiration. So again, example, current stock price of IBM, let's say is $183 per share, and you've bought one IBM March 180 put option contract. Again, let's parse that statement. You're buying one contract here in this example, which is for 100 underlying IBM shares, to sell 100 underlying shares. It expires in March, so it's the third Friday of March. As I told you the last class, that option expirations in a given month always occur on the third Saturday. The last trading day is the third Friday of that month, and then the option officially expires Saturday, when there's no trade, of course. And then the strike price is $180 of this contract. Okay, so that gives you the right, but not the obligation, to sell one contract, 100 IBM shares at $180 or less. Well, at $180, right? So, and understand that IBM is obviously trading at 183, and so by the definition that we've established in the last class, this is an out-of-money option. Why? It's an out-of-money. So there are these two terms, in the money and out of the money. This is an out-of-the-money option because you can do better in the open market currently. Right now, IBM is trading in the open market at $183 a share. If you want to sell IBM, the put option, if you want to exercise that put option and sell that IBM stock, you can do so for $180 a share, which is the strike price. However, you can do better in the open market at 183. So you're not going to exercise this put option at this point. And therefore, it's out of the money currently. It is not sensible to exercise this option currently because it's going to be no sense for you to do that. You're better off just simply using the open market at a better price. Now, the reason you've bought this is, if you've bought it at all under these terms, it is because you believe, for whatever reason, that before it expires, anytime before its expiration in March, that IBM stock price is going to go below 180. That's the whole idea. Otherwise, there's no sense why you would buy this this put option. That somehow you believe your research, your data, your information, whatever, has suggested that IBM stock should be trading below $180 within the next few weeks. It should drop below 180, which is why you bought this option, put option. Okay, so that's sort of the thinking behind why you might want to buy a put option. So remember, we talked about call option. You buy a call option when you believe the underlying shares will increase in value. That's when you buy a call option. Similarly, you buy a put option when you believe that the underlying shares will decrease in value. Decrease in value. So it's the other way around, right? So that's one way you can make money in a falling market, right? So when we talked about stocks before we started on options, we said, well, how can you make money with negative information, right? We know that it's easy to see how you can make money in a positive environment. If you know that the stock price is going to go up in value, you simply buy the stock before it increases in value and then write up the price. In the world of selling shares, if you have negative information, or if you believe something negative is going to happen, then the way you make money is by shorting the shares. You short sell the shares. That is, you borrow the shares from your broker, sell them, realize the high price, and then buy it back later at a lower price if you're right, and cover your shorts. That's one way to accomplish making money in a negative environment. Another way is to buy a put option. So now we have another way to make money in a negative environment, that you simply buy a put option. Put options become valuable when the underlying shares go down in price. Just like call options become more valuable when the underlying shares go up in price. So it works, the mirror image. All right, close. All right. So, it's not moving, Michael. Let's see. Let's try that. Or maybe it's, I don't know. Tap on the screen? Okay. All right. All right. Okay, so again, this is the payoff graph for a put option. When you're long put simply means you've bought it. So in the world of options, when you think of going long, you're talking about buying. Going long is buying, and shorting the put means selling the put. Okay? In the world of options, going long is to buy, going short is to sell. So notice that if you're a put option, you're making money when the share prices are to the left. That means they're going down in value. That's when the price of the put options are going up in value. And again, remember, and don't forget the fact that very few people, very few people, almost nobody, ever converts the options into stock. They simply buy and sell the options themselves. Okay, the contracts themselves are bought and sold. Hardly anybody ever buys the put option and then delivers the shares or whatever. You just simply sell it back or buy and sell it back at a profit or a loss. Because understand that when share prices go down, and if you're holding a put option, that put option is itself going to increase in value. We saw that in the example last time, the numerical example with leveraging, when I was demonstrating that. So people are buying and selling the contracts themselves for profit or loss, or you sell it when you know that the prices are going the wrong direction. Let's say you bought a put option. You expected the price to go down, but it didn't. For some reason, it didn't. You were expecting it, you did your research that was suggesting it would, but it didn't. And expiration is coming up. What do? You simply sell it back and recoup a part of your losses. Because obviously the contract is now trading for less value than it was when you bought it, and the difference is your loss. But at least you don't make the whole amount as your loss, you recoup a part of it. Just like in a stock situation, when you buy a share, 100 shares of some stock, and the stock is not going up in value, and you decide to recoup your losses by selling it for whatever it's trading for currently, and the difference between what you paid and what you got when you sold it back, minus commission, is your loss. Okay? So that's sort of the whole idea here. All right. I just told you that. And now pricing. One of the reasons why, so derivatives as a contract has been around for centuries. Okay, this is not new. People, if you go back millennia in the old, trading days of the Abyssinians and Romans, their discussion of derivatives contracts. Farmers bought weather-related contracts just to safeguard them from weather uncertainties and things like that. Grain merchants did that. So derivative stuff has been around. The only problem was nobody knew how to price them accurately. Nobody knew how to price these things accurately. So in the early days, people would just sort of guess at what price it was. There was no real quantified way to approach pricing of derivatives contracts. That was a big barrier. So even though these things, derivatives contracts, have been around for thousands of years, really, in terms of precise mathematical formula, there was nothing. Nobody understood how to price these things. That all changed in 1971 when two economists wrote a paper published in the Journal of Business. It was published in 1971. They came up with this, two guys, Fisher Black and Myron Scholes, came up with this Black-Scholes option pricing formula. And they actually used an engineering formula driven by heat equations. So it's a convection heat equation, fairly well known to mechanical engineers who do heat transfer. And it was basically an idea that they took from there, and they came up under fairly strong assumptions they could price these options. They found a way to price these things in a mathematically sound way. Once they did that, the doors opened, and the options exchange for the first time was created the following year. In 1972, you had the first options exchange open based on the fact that we now had a way to price these things. And now we were off and running. So, and Black-Scholes is a very difficult formula, although now all traders, option traders and stuff, have the thing programmed in their calculators, and so they can punch out numbers very quickly with the input and output. But it is a very complex equation. It's an extremely complex equation to solve. Nope, where did it go? Where did my thing disappear? Oh, that's you. No. All right, I'm going to just follow this.
Okay.
So we need to, change. All right, so as I said, exercising options, I've told you that. And so, okay, so now shorting. So remember I told you that options are a zero-sum game. So for every buyer, there's a seller. For every seller, there's a buyer. So we've talked about buying options, buying call options, and buying put options, right? Well, there's the other side of that trade. You can sell the call options, and you can sell put options. Why would you do that? Well, there's certain advantages to selling these options. When you sell something, you get money up front for selling. So when you are a seller rather than a buyer, the advantage is that you get money right away. You sell a contract, you get paid for it. There's a value to it, so you incur the proceeds, minus commission, of course. That's a given, so I'm not going to keep repeating that. So you're going to incur the proceeds. Now, what's the other side of that coin? What's the downside? Well, I mean, as in anything, there's a good and the bad, not so good side. The good thing about shorting options is you get paid right away. The bad thing is that you do not want that thing exercised against you. Because if it gets exercised, then you have to follow your end of the deal. So for example, if you are selling a call option, if you sold the call option, somebody bought that call option, right? So whoever bought the call option obviously bought it because he or she believed that the underlying share price was going to go up. You sold the call option. Why? Because you believed that the share price was going to go down. Now, one of you will be right in this equation. Either you'll be right, that person will be wrong, or you'll be wrong, the other person will be right, and vice versa. Well, if you are wrong, that other person's right, then the share price goes up, then guess what happens? Your value you will be, that other person will obviously exercise that option, or in other words, can sell it back, but at a profit. Your contract price, the selling, the put option, the call option that you sold, is now going to be worth much less, and you're going to incur a loss. The other person is going to make a profit, equivalent to your loss. Remember, it's a zero-sum game. So when something goes up, the other side makes the profit, you incur the same loss, and vice versa. So it's the same thing with the put. When you buy a put, somebody sold the put. You bought a put because you expected the stock price to go down in value. The other person obviously sold the put because they expected the stock price to go up in value. So one of you will be right. So it's an up and down game, right? Either you're right or you're wrong. Now, if you know that you're going to be wrong, obviously you have time to sell that option back in the market, do the reverse transaction, and close out the trade at whatever price you can recoup, and then just manage your losses that way. So that's sort of the way this thing works. Bottom line is, being on the selling side of options is way more riskier than being on the buy side of options. When you buy a call or a put, at most what you lose is the price you paid to buy the option. At most what you lose, let me repeat, at most what you lose is what you paid to buy that contract, which is usually a very small, relatively small amount. That's the maximum of your losses. It's most of the time, all of the time, it's not the max because you sell it back and recoup some money out of it, some residual money, so it's not a total loss. But on the sell side, when you do sell, you can be asked to deliver against those option contracts, underlying shares. You can be asked to do that. There's a possibility, and so you have to be prepared to do that, unless you sell it out quickly before that happens. But the point is that there is more risk involved in being on the sell side of an option trade than there is to be on the buy side of an option trade. So I always tell people when they talk to me about this option trading is that if you really want to test the waters initially, where you're not so sure about how it works and you want to get a feel of it, be on the buy side of the market. Do some buy trades. That way you can test the waters, you can see how it goes, and incur a relatively small cost for doing so. So it's always best to start off by being on the buy side of the option trades, whether it's a call or a put, to see how it feels and to better understand the currents of option trading. All right. So when you short a call, profit is limited, losses are unlimited. Shorting is overall very risky. When should you use it? For example, when should you short the call, right? So obviously when you buy a call, you expect the underlying market to go up, which is why you bought the call. So when you short the call, when you sell the call, you expect the reverse. So now we have another additional strategy to work with when you have negative information. So we talked about two things so far, right? Let's say you have negative information. You know that something negative is going to happen in the market. Things are going to go down in value. So you could short the stock first. Second, you could buy a put option. What's number 3? What's number 3? What's number 3? Come on. We just talked about it. What's number 3? I know I can keep repeating what's number 3, and it's not going to. You can sell the put. You can sell the put. You can short the call. Or I'm sorry, you can buy the call or sell the put. So you can actually, so if you have negative information, you buy the put or sell the call. Okay, so that's the third one. You can sell the call option. Not the buying of the call option, you'll sell the call option. So buying a put, selling a call, shorting the stock. Now now you've got 3 options. You've got choices now. If you have good news, you buy the shares, obviously, the simplest one. You buy a call option, or you sell a put, which has essentially the same goal. So now you're getting, as we move along, as investors, you have more choices. Somebody asked the question, why even bother with option? It's because it gives you different ways to trade. People like choices. People like different opportunities to trade in the market. Right? So that's sort of the, again, I'll just blow by the payoff. Okay. So again, we sort of looked at this example. Didn't we cover an example on leveraging before? Okay, so here's another one. All right, so again, it's the same kind of idea. We covered one example before, so here's another one. Let's just see involving Microsoft. So let's say one share of Microsoft currently is at $31.19 a share. You buy 10 Microsoft March 30 call option contracts. Let's parse that, right? You've got 10 contracts. Each of them are worth 100 shares. So you're controlling with 10 contracts, 1,000 underlying Microsoft shares. So you buy a March contract, so it's going to expire on the third Friday of March. It's a strike price at $30. Okay, and so you paid $1.27, so that's $127 for each contract, right? Because there's each of the contracts worth 100 shares, so it's $1.27 times 100 for each contract. That's $127 for each contract. You've got 10 contracts, so that's $1,270. 127 times 10. So that's how you get a $1,270, right? So that's your cost. And remember, the strike price of this contract is $30. Currently, it's trading at $31.19. So what kind of a contract is this? Is this an in-the-money contract or out-of-the-money contract? First thing. What do you think? You can speak up. There's only one of two, right? So you'll be right with 50% probability. Take a chance. Huh? Out? And my friend, you're wrong. It is in the money. Why is it in the money? Okay, now explain. Now that I've told you it's in the money. Why is it in the money? Because you can exercise it to buy right away at $30, whereas in the open market it's trading at $31.19. So you can buy it below market. That's why it's in the money. No, so okay, I was worried somebody's going to bring this up. Okay, there is a difference between European options and American options. These are all what we discuss are called Europe. This got nothing to do with whether they're traded in Europe or America, by the way. Just like French fries were not, versus freedom fries and all that stuff that we went through. No. This has got nothing to do with where they're traded. It's just the names that have been given for some obscure historical reasons. But what we are talking about, you're correctly, this is not American-style options. These are European-style options, which means that you can, any time before it expires, you can execute them. If you. Is that right? I'm now confused. Maybe you're right. I'll have to check that. But basically, what we are talking about here is that any time before it expires. That's the most common form of options. Now, whether they're American or European right now, we can double check that. But that's basically it. The difference between those two is, in one of them, now you've gotten, I'm doubtful now. I'm starting to, we can look this up quickly. But the point is, Maria, can you check that and let me know? But in one style, it's like you can do it once. And in the ones we are talking about, it's like any time before it expires. That's the understanding. Okay. Alrighty. So choice A is buy and sell the options contracts only, and choice B is buy and sell the stock only. So if you just so choice A is the leveraging choice, and the choice B is the straight up stock purchase, which we all understand fairly well by now. Okay, so we simply buy 100 shares of the underlying of Microsoft. All right.
I have the answer to your question.
Please
So,
give us the answer.
Owners of American-style options may exercise at any time before the option expires, while owners of European-style options may exercise.
I win! No, just no. Did I? Or you won? No.
American, you can exercise at any point.
Any point. So that's what I'm wrong. You're right. I'm wrong. You're right. All right. We've got that settled. But we're talking about where you go. This is really the way option trades work in this country, so we don't have to worry about So you can exercise it anytime before it expires. So choice B is is buying and selling the stock only. That's a non-leveraged option. All right, moving on. So again, two things can happen before. So we're just picking two numbers, right? One where the stock goes up in value, and the other it goes down in value. So let's say this is the good scenario. You bought a call option, stock price goes up, Microsoft reaches 33.08 from 31.19 between now and 28th of March, which is the third Friday, I guess, right, Mike? That's how you chose the 28th? It shouldn't be, because third Friday, that seems too late for the third Friday. Okay. So between now and it's somewhere around 21st of March, because again, remember, it's the third Friday of March where it will expire. So if you have to be precise, then all right. So the same call option contract is now trading. Because the stock price went up, the call option price has also gone up in the meantime. So as I told you before, now the same option contract is now trading at $250 a share from $127. So now if the value, the paper gains that you have, is 2,500 minus 1,270 divided by 1,270, which is the straight up return calculation, almost doubling your money. You've got a 97% profit, paper gain sitting on it. But if you didn't, if you just simply played it safe and bought 100 Microsoft shares instead, you're sitting on a 6% gain based on its current value. So notice that that's the difference. Because of leveraging, you've gotten, when things went your way, you almost doubled your money. Now, if the bad side thing happens as an option holder, let's say Microsoft goes down unexpectedly, whatever, it drops to 28 between now and 28th of March. The same, in other words, not 28, but before expiration, whatever that is. The same call option contract has now gone down in value. It's now 30 cents. Right, 30 cents a contract. So now the total value is, to use 10 of these contracts, it's $300. So you can simply sell it. That's why I said you can sell it for what it's worth and recover part of your losses. Now your loss is 76.37. But if you just had a straight up stock deal, then you lost just 10%. So minus 10 versus minus 76%. So that, again, is an example of leveraging. Leveraging works really well when things go your way, your gains are seriously magnified, but it also hits you hard on the other side of the coin. When things don't go your way, you lose a lot more money as well. So that's the advantage and disadvantage of leveraging. Okay? All right. Okay, so here's a summary. Huh?
Do we want to take a look at that?
We will. I want to see what questions there are so far. FYI, me, Maria, and Michael are both responding. Okay, good. What is determining? What goes in determining new price of the call option? If the again, that's the okay. Good question. What goes into determining the new price in the call option if the stock price goes? That's the Black-Scholes, the magic of Black-Scholes. It's a continuous time where you can trade, you can put in the inputs, and you can. It's a differential equation if it means anything. So it is. You can program that in and get these prices constantly. So that's how you're doing, evaluating prices all the time. So Black-Scholes, and there are now binomial pricing models. There are a whole bunch of different models. Approximately, they give similar answers, but there are different. Options, formulas now available. Some are simpler than others, but basically the workhorse is the Black-Scholes model. Okay, so just to give you a sense of how this thing works, so we're talking call options here, okay? So look at, this is Apple's call option. We are looking at, when is the expiration here? This is March. Go to March, this is too close. Go to March 14th. Yeah, click on that one. That still has some life in it. All right. So March 14th. That's the third. That's the third Friday or Saturday, whatever. That close enough. That's the third one, not 28 that we have in the example. So March 14th. Oh, well, I was wrong again. Boy, I'm just striking out today. All right. So that is that's surprising. Can you check the March calendar? That seems too late to be a third Friday. Yes, but that's supposed to be on the third Friday. Okay, we'll have to check that one out. All right, so this is my day, you can tell. I'm just really rocking it. All right. So let's look at the strike prices. And there's Apple's trading price at $527.80. That's per share value. And look at the strike prices. So let's go somewhere near where the action is. So let's go down to, yeah. There you go. So that's where some of the action is. And look at, well, look at on the, so where is the stuff going on here? What was the price again? What was Apple at? 527. Okay, let's go down now. All right, 527. Keep that in mind. Okay, so when you go to 530, look at, there's a lot of action. And the last column is number, so the last column that you can't read anymore is the number of contracts that are outstanding. That means that those are the contracts that still are out there. People have not either sold them back or exercised them for stock, whatever. That'll tell you the action on a particular strike option. And look at the prices. Those are the 620 is the price, $6.20 for a $530 strike option. So for 100 shares, it'll cost you $620 with that strike. And it has 1,281 contracts that are outstanding currently, activity. But look at the 530. What's the first column? Go back up. I want to look at the headings of the columns. Open interest. Okay, the last price change, bid ask. Okay, go down now. I've seen it. So look at the bid ask prices. So the third and fourth columns, yeah, those two are the bid price. The 610 is the bid price, 630 is the ask price. So again, they are traded just like stock contracts. There's a bid ask price for it. So the ask price is $6.30, bid price is 610 for that strike, 530. And number of open interest, which is the last column, is 1281, which means that there's a lot of activity relative to the ones you see around it, with 66 contracts, 13 contracts. So, and then you go down to the one that's, the one that has 5,614, that's, so that's 530. What's the 995 again? I forgot that. What's the first one? Oh, the last trade. Okay, don't worry about it. Yeah. And so you can see that the 530, what's the difference between the 530 there and the 530? What is it? Why they're all the same strike?
The first number after the L.
Different series of stocks. Yeah, they have different series here. Yeah, that makes it a little bit more complicated. But here's what I want to point out is that look at the open interest in the call side is on with a strike of 530 with 5,614 contracts, open interest contracts. That means one way to interpret that is that the market believes that in the month or so that's left before this contract expires, the market believes that the stock price is going to be around 530. Okay, which is why there's a lot of action around that 530 strike. Let's look at the put option for quickly. Let's go to the put side of the thing and let's look at what's going on there. Okay, so here are the put options on the same expiration date. So let's go down to where the action is, for 500 in the 500s. So again, you see 530 put has 6,661 open interest. Now here's another secret. I'm going to let you on. When you are looking at, so if you want to, so let's say you're investing, right? You have no interest in options, and it doesn't matter. But let's say you are thinking of investing in a given stock, let's say Apple, and you want to see what the smart money is thinking. It's sort of like saying, what is Las Vegas going to do? What are the smart boys going to be doing in terms of odds on something going up or down? Similarly, you can say, what are the option traders thinking is going to happen to the stock price in the short run? One way is to look at where the option action is, calls and puts. So we can see that in this case, with the March expiration, 530 is where the call and put are both sort of glomming onto that 530. if I were to look at this data, my conclusion would be, a reasonable conclusion would be that Apple stock is not expected to move much from its current value in the next 2 or 3 weeks. It's not, the market doesn't believe that there's going to be anything happening in Apple in the next few weeks before this contract expires. It's actually very nice. Seldom do you see such agreement on the call and put side, but in this one it is actually. So looking at the open interest, the last column, and looking at where the largest number of open interest contracts are on which strike, and comparing that to the current value of the stock, both from the call side and the put side, will give you a decent idea of where the market believes, what window the market believes that stock is going to be in the next few weeks. And that's an important way to understand where the stock price is going to be. So if you're looking for a quick way to make some money in a stock, now this is not a foolproof way, obviously, and I'm not going to guarantee it, but one smart way to do it is to look at where the option markets are predicting the price will be, and then playing the spread over there in the short run. And you can pick up a few dollars doing that, playing that strategy. So let's say you believe that the current stock price is, not believe, you see the current stock price is at 530, for example, and you see that the market is sort of suggesting that the price might go up to 535, 536 in the next few weeks. Well, chances are that you're going to, if you take a position like that in the next few weeks, you'll pick up some returns. Not a big one, but some. You know, depending on how much money you put in, you'll make some money. Now, does this work all the time? Maybe not. But it works more often than it doesn't. And so there is again, as long as you're reasonable and you pay attention to all the details, how the market is thinking. Now you have to check that to see if the market's sentiment changes or not. But this tells me, looking at this data right now, it tells me that market is not expecting Apple stock to move significantly in the next few weeks. It's going to be where it is. Okay, any questions here? Can you zoom the screen a bit? Can't see numbers from the back. Can we zoom?
Well, already did it.
Oh, okay. All right. So you said the options are no good if a corporation goes out of business. Then is there security? Well, if a company goes out of business, very few things are any good. Even stocks are no good. So options being derivatives of stocks, obviously they're no good either. So if underlying business goes out and becomes bankrupt, then as an investor you're in trouble. Now you could be a bondholder, and we'll talk about that soon, and you'll be a senior claimant in the payoff process. So bondholders get paid off first, but stockholders get paid off last. And so yes, I mean obviously that's a risk you take when you get in the investment world, is that the underlying business will go out of business. Now will go bankrupt. Now that's why you restrict, if you're risk averse and you don't want to go into that kind of stuff, then you need to stay with companies that are highly rated, that are not likely to go bankrupt, right? I mean, a company doesn't overnight go bankrupt. Now, Apple is not going to go bankrupt tomorrow. We know that. Google is not going to go bankrupt tomorrow. Microsoft is not going to go bankrupt tomorrow. So you can rule out, I mean, if you stay within a certain class of stocks or investments, bankruptcy risk is probably not something you should be worrying about. Now, if you play the market in the speculative arena, like you play the penny stocks and you play the pink sheet stocks and you're doing all that, then of course bankruptcy risk is a big concern, but you factor that in. That's the arena you want to play. That's the high risk world. And therefore bankruptcy goes hand in hand with that risk, with that world. So you have to pick your poison as to where you want to center your attention, and that is related to how much risk you're comfortable taking. That's where you come in deciding what works for you. Okie dokie, let's move on. Okay? All right. Yeah, we've talked about that. Oh, bonds, cool. All right, let's do a little bond stuff. A few minutes that we have. Let's start. So bonds, borrowing. We all borrow money, right? We go to a bank, we borrow money to buy a house, property, car loan. All that really is borrowing money. Bonds is nothing but a systematic way to borrow money. So when a company needs money to grow, they have several options. When we need money as individuals, you and I, we have options, but not so much. we have options, very few options as it turns out, but one of our options is to go to a bank and apply for a bank loan. That's nothing but bonds. This is when we borrow money, we sell a bond. Think of it as selling a bond. The bank is buying the bond from us when we get money from a bank. Okay, so when we borrow money from a bank, we are essentially selling the bond to the bank. When a company borrows money from the capital markets, they can do so with selling stocks that we've already seen. They can also sell bonds in the market to raise money. In fact, corporations very frequently do both. They raise money through sale of stock. They raise money through sale of bonds, many different kinds of bonds all at one time. Typically, they don't borrow from banks because the money that corporations need are pretty large dollar figures, and most banks don't have the capability to fund that kind of stuff, those kind of needs. So banks are pretty much out where corporate stuff is concerned. Banks are good for lending to us because our needs are considerably modest, right? We want, a few $100,000 to buy a house, a few $1,000s to buy a car. Those things banks can give, though that kind of money the bank has. But companies typically need billions or many millions, $100 million, $200 million, $1 billion, $10 billion. Banks don't typically have that kind of muscle. So it turns out that everybody sells, bonds and raises money. The corporations do, the federal government does, the state governments do, municipal governments do, local governments do. So it's a very popular way of raising money, right? And bonds are, unlike stocks, and most of you know this, so this is hardly a surprise. Stocks, when you're a stockholder, you're a part owner of the company. We've talked about that. You're a part owner. It's an ownership instrument. Bonds have no such thing. Bonds are just simply lending instrument. You are a creditor. When you buy a company's bond, you are a creditor of the company. You've lent the company money. That's all you've done. You have no ownership stake. So what are the trade-offs? One major trade-off is that bonds are considered safer instruments. So if a company, the underlying company goes bankrupt, as a bondholder, you are what is called a senior claimant. You stand ahead in line to get paid. So when you're a bondholder, chances are that you'll recover most, if not all, of your money if the company goes bankrupt. Whereas if you're a stockholder, you are a residual claimant, which means that you are last in line. You are paid only after everybody and their grandparents are paid. Then comes your turn, and by that time, there's nothing left over. So typically, you have no luck if the company that you have shares in goes bankrupt. So, but on the flip side of the coin, if a company does well, as a bondholder, you don't get anything extra. You simply get the interest, just like you as a bondholder, you get paid the interest on the money you've lent the company, and that's all. As a stockholder, the value of your stock goes up and you make significant returns. So again, being a stockholder means you make more money on the upside, you lose more money on the downside. Being a bondholder, it means you make less money on the upside, you also lose less money on the downside. So think of this as being a stockholder is like a leverage strategy, whereas being a bondholder is like an unleveraged strategy that we just discussed, where both gains and losses are magnified under the leveraging strategy, whereas gains and losses are muted in the other strategy. So think of it that way. Again, all of these entities sell bonds. And so you get a certificate, and it tells you, the certificate says how much, what is the principal amount that you're lending, which is a standardized amount. What is the interest rate? What kind of coupon payments you're going to get. So this term coupon payments is just interest payments that you're going to get paid as a bond holder. The term coupon payments comes from an arcane term 50 or 60 years ago, before the advent of computers. What happened was when you bought bonds, you also got issued a company's coupon book that will send you in the mail, and all you had to do was every 6 months tear off one of those coupons, mail them into the company, and the company would send you a check. So that's how nowadays, of course, as you know, everything's computerized, so there are no coupon books, but the term has stuck, and that's how you refer to it, so coupon payments are nothing but interest payments, and you typically get those every 6 months. And the term of the loan. So loans always have a finite period, and so you know it's a 10-year bond or a 7-year bond or 5-year bond, 30-year bond, and so you know when that term will end. Okay, so just like mortgage payments, think of the mortgage loans. Same thing, right? 15-year loan, 20-year loan, 30-year loan. So it's same thing with bonds. And bonds are known as fixed income securities. So that's when you hear the term fixed income, they're talking about bonds. And the reason being, in bonds, your income is fixed and predictable, more or less. Unpredictability comes if the company goes bankrupt, but for the most part, it's a predictable instrument. You know how much you're going to get in coupon payments. You know when it's going to happen. You know for how long it's going to happen before the bond matures. So all those things are known. Okay, so there's very little uncertainty, which makes bond pricing relatively straightforward. It's a straightforward application of annuity. Okay, and you can figure out stock pricing is much more difficult because of the underlying uncertainties of how long and how much and all that cash flows and stuff. It's a lot more difficult to value stocks, a lot easier to value bonds.